Good afternoon, everybody. For those of you that are on the East Coast, those of you on the West Coast, happy late morning. We're going to go ahead and get started here. If you don't know me, my name is Ryan Melliker. I am the president and co-founder of Lodging Analytics Research and Consulting, or LARC for short. We're going to jump into a presentation in just a minute. Before I jump in, I just want to highlight a couple things to everybody. Number one is this webinar is being recorded. We will send out the recording if you need access to it and have to pop off. Don't worry, we will get it out to everybody. We will also send out the slide deck to everybody on the webinar. So if you missed, if you want to get access to that, don't worry, you will receive it. You don't need to ask us about it later, though I'm sure that will happen. Other things I'll highlight is that there is a Q&A button in your Zoom toolbar. I'm sure you're all familiar with that by now. Lob in questions. We're going to save the questions till the end of the presentation, and then Katie Harding from the LARC team is going to go through them one by one with me, make sure we address everything. If we don't get to your question, or you're not comfortable asking it in this forum, don't worry. Feel free to reach out to us at either information@LARC Analytics, that's LARC analytics.com, or you can email me directly, ryan.melliker@larcanalytics.com. With that being said, I am going to jump right in now. I don't want to waste any more time. We've got a lot of ground to cover. We're going to walk through kind of recent performance real quickly, and then we're going to jump into the economic outlook. And we spend a lot of time on kind of the current U.S. economy and the drivers and how things are going to perform and how they pertain to the different demand segments. And then we'll get into our U.S. Industry forecast with a focus more on 2025, followed by profit and values. And then we'll walk through some market highlights, and then we'll dig into one market in particular. That being said, let's jump in. When we think about the U.S. industry review, many of you have probably seen this slide before from us. What I will tell you is that, when you look at this slide, this chart, particularly one of these quarters, does not look like the others, right? The reality is 1Q 2023 had a lot of tailwinds tied to soft comps from the Omicron variant in 1Q 2022. But then if you look as we went through the quarter, went through 2023 and 2024, you saw RevPAR growth gradually decelerate from 2.7% in 2Q23 to 1.8 in 3Q to 1.5 in 4Q. Then it went all the way down to flat in 1Q 2024. Now, 1Q 2024 was negatively impacted by the Easter calendar shift. That probably had, a few tenths of a point impact. So maybe you'd be looking at more like 0.5% growth, if, slightly better, but certainly not as bad as this. Then 2Q 2024 had two big impacts. Number one was that Easter shift. Number two was the solar eclipse. If you adjust those out, probably saw things slightly better than we saw in the first quarter, but not that big gap that you see there. And then 3Q pulled back down to about 1% RevPAR growth. Again, I think what you're looking at here is a slight acceleration from what looks like a bottoming in 1Q 2024. Even adjusting out the Easter shift, probably still a bottom there, as we're seeing ever so slightly ticks up going forward when you adjust out some of that noise. But not every market performed the same, as I'm sure you guys are all aware. These two charts kind of show you the top performers and the bottom performers in 2023 and what we think they will be in 2024, with most of the year complete now. One of the highlights here is really just that there's a big divergence in performance, right? Markets like DC, Las Vegas, New York, we were talking close to 20% RevPAR growth in 2023, while the Florida Keys, Santa Barbara, down close to 10%. And in 2024, you also had a really big divergence. Houston up close to 15%. Some of that's impact from Hurricane Beryl, whereas you have markets like Maui down close to 10%, others down close to 5%. Just gives you a sense that just because a market the national average is performing one way does not mean a market is going to perform that way. Every market has its unique drivers. At LARC, we focus on trying to build out understanding of each individual market to give us a sense of how those markets are going to perform going forward, understanding the true drivers of those markets as opposed to the one-size-fits-all approach. I laugh when I meet with investors that will be like, well, we just kind of follow jobs growth. I'm like, oh, really? You think jobs growth drives hotel demand and call it the Florida Keys? They're like, well, no, why would it drive demand growth in the Florida Keys? That's a tourist market. Oh, so is there no tourism in New York? You know, the understanding the factors that actually drive hotel performance and across each of these markets is really, really critical to understanding how these markets are going to perform this year, next year, the year after that, the year after that. And that's what we tend to focus on at LARC. And you can see how wide that divergence can really be just by looking at these two charts. Moving beyond the top line in 2024, nationally, back to national levels, occupancy looks like it's going to be ever so slightly negative. ADR, positive. RevPAR somewhere around 1.5% RevPAR growth is around where things are going to net out this year. EBITDA is going to be negative as expense growth outpaces revenue growth. But we actually see values increasing this year. How is that possible? EBITDA is down, and we actually point to cap rates rising this year. So how does that work? Well, I don't know. Most hotel investors don't value hotels on a single year's cash flows or hotel EBITDA, right? They're valuing them on a discounted cash flow basis. And the reality is the outlook for hotel EBITDA and hotel cash flows has drastically improved over the next few years from where it was a year ago. This time last year, we were forecasting negative RevPAR growth in 2025, if you recall. And that dynamic has meaningfully shifted, and that is what's driving that value appreciation. Is the outlook for cash flow growth has gotten a lot better, even if the outlook for cap rates has not. And as we look past 2024 and the softness that we're seeing this year, now moving on to the economic outlook and the implications of that economic outlook. Before I flip the slide, I just want to highlight how we think about things. We're going to be focusing on the three core demand segments: corporate transient, group, and leisure, identifying some of the factors that we're really focused on that help really pave our view for those segments with a focus more on 2025 than any other period. Now, the other thing I'll keep in mind is that I'll highlight is that as we talk about this, there are some areas that we are out of consensus, and I think it's important to understand that. We'll try to flag those points out. First and foremost, we can talk about corporate transient, and we focus on office utilization. When we talk about office utilization, how many people are in the office? The reality is, why does this matter? Well, if people are in the office, companies can travel to see them in their office. If they're not in the office, they're working from home, you're less likely to go travel to meet with that person. It just becomes less and less likely. That has played a role. It has certainly proven out in terms of corporate transient demand volumes and where we are today versus where we were pre-pandemic. It does have an impact. Office utilization restraints does have an impact on overall corporate transient demand. And then you see headlines like this: oh, maybe things are getting better. Maybe we're at an inflection point. What I can tell you is we've seen these headlines for 2 years, right? These are nothing new. We've selected a couple of them from the past few months, but you go back to our slide decks of the past, you can find headlines just like this literally every quarter for the past 2 years. And we obviously have not seen a meaningful movement. To give you an idea of not seeing that meaningful movement, here's data from Castle Systems. Castle Systems is not the end all be all. We're not going to sit here and tell you, oh, Castle's amazing. This is perfect data. It's not perfect, but it does give us a sense of how things are moving. At the end of the day, Castle Systems is tracking swipes in and out of office. So it's very focused on kind of the security oriented office buildings and companies that require security. And as you look at that, you can see, oh, okay, things over the past 2 years have been mostly stable, ticking up maybe ever so slightly, but still hovering around that 50% level. Now, we don't believe the 50% is an indicative number because we don't think it was ever at 100%, like Castle Systems has indicated. But generally speaking, things have moderated, and that moderation from pre-pandemic levels. And the bounce back has now plateaued. And if you don't trust Castle Systems, here's another data source that I think is particularly interesting. This is the Flex Index. The Flex Index is a company that actually surveys over 13,000 corporations, 100,000 office locations, and over 100 million office employees. It's a massive, massive endeavor. And they've been doing this for about 2 years now. And you can see some of the quarterly survey results here. Now, the highlight that I would say is that on average, across all of those companies in the US, on average, companies require people in the office 2.78 days per week. That's up from last quarter at 2.63 and the quarter before at 2.49. So there's a clear positive improvement, but it is not a big improvement. We're talking, 10, 20 basis points a quarter is a marginal improvement. Now, over time, that could tick up meaningfully. But why is that number moving higher? It's moving higher because this 3 day per week is increasing. And what's happening is you're moving less from, the 0 days are going down and the 3 day per week is going up. It's not 5 day, it's not 4 day. You're just seeing movement in the 0 to 3. That's encouraging and it points to improvement, right? Improvement is a good thing. But the flip side of that is we're not seeing it move to this. So when we think about those metrics, we're basically saying, hey, there are some modest tailwinds from office utilization continuing to ever so slightly expand into 2025, and we see that, and that's encouraging. However, if you are someone that feels like, hey, we can get to back to where we were in 2019, I think that ship, I think, is sailed. We are a long way off, and it's unrealistic to expect that. So just something to keep in mind when you think about office utilization. Now, the reality is if you see more and more of companies in this world moving to the 5 day work week, that's going to have a negative impact on group and a negative impact on leisure. But when they're just moving to that, just keeping that 3, still leaves plenty of opportunity for long weekends from leisure and still leaves plenty of opportunity for companies who want to get their people together from a group perspective. Overall, you've gradually been seeing work flexibility continue to hover around 68% of total, of total companies. So there's still a lot of flexibility with the structured hybrid model gaining a lot of momentum. Now, that's encouraging, right? Encouraging, but not, overly bullish. Then if you flip to the next slide, one of the things that's less encouraging is let's take a look at the sectors or the industries that offer the most flexibility. Technology, insurance, financial services, professional services. Uh-oh, those are the 4 industries that the hotel industry tends to cater to the most from a corporate transient perspective. And they're offering the most flexibility. That means the PwCs and the IBMs, the Morgan Stanleys and the Goldman Sachses, obviously all the big insurance companies, the Googles and the Apples aren't necessarily people aren't traveling to see them as much. And that has an impact, especially if you think about some of the largest accounts at your hotels, what that weighs on. So just something to be mindful of. This data tells us, hey, there is a modest tailwind. We should see office utilization expand slightly in 2025, and that's encouraging for corporate transient demand. That's the bottom line there. The flip side of that is other data is less encouraging for corporate transient demand growth in 2025. So corporate profits were up slightly in 2023. Then they were up almost 8% or expected to be up almost 8% in 2024. Next year, they're expected to be down 2%. Corporate profits and stock market have historically been indicators of corporate transient demand. When companies have higher corporate profits, they're not putting the squeeze on their spending and they're more willing to go travel to try to generate revenue. When stocks are higher, they're not as concerned about their spending, more focused on generating revenue, right? Stock market up 27% year to date or so, up 24% last year. We're now 87% above 2019 levels. That's great. And it's encouraging for what we've seen to date. I don't know where the stock market's going to go next year. I'm not claiming to know where the stock market's going to go next year, but almost double where we were at the end of 2019 seems a little inflated. And I'm concerned that we might see a little bit of a pullback there. And if we see a little bit of a pullback there in conjunction with declining corporate profits, that could weigh on corporate transient demand as well, because again, these are factors that have historically had a strong relationship with corporate transient demand expansion. I'm not saying that corporate transient demand is going to contract meaningfully next year, but these are going to limit the growth. And if you're only seeing modest office utilization expansion, that growth is going to be even further limited. Still maybe slightly positive, just not meaningfully positive. Now moving on to group. We track the 30 largest convention centers across the US. When we look at this, the reality is this data remains incredibly encouraging. 2023, as many of you know, saw convention room nights up 12% year over year. 2024 was up 4%, or we estimate will be up 4% by year end. And 2025 is actually pacing up 5% year over year. That's a big number, up 5% year over year. It's big, especially considering this time last year, 2025 was pacing negative. So we saw a lot of bookings in 2024 for 2025. Very encouraging. 2026 is also pacing up nicely. See a little bit of a pullback in 2027. There's a lot of time to play catch up there, similar to what we did in 2025. And then we see some really strong growth in 2028. Bottom line is group looks positive. We're seeing a lot of strength from group, not just in 2025, but beyond. But not every market is going to experience that strength. To give you an idea, some of the strongest markets, Orlando up 45% year over year next year, San Francisco up 45%. San Francisco is going to have a great group year next year relative to 2024, but it's still about 30% below where we were in 2019. 2024 was a really, really bad year. So it's going to be way better this year than 24, but nowhere near where people are hoping it might get back to. And then Denver up 27% as well. Some of the softer markets, Austin down 25%. The convention center is closing for redevelopment in March. Atlanta and Philly also down pretty meaningfully. We'll talk about Atlanta a little bit more in a bit. Then now let's shift to leisure. Now, leisure is probably where we are the most out of consensus for 2025. At the end of the day, if you go back and look at our webinars from a year to 2 years ago, we talked about the concerns that we were seeing from a leisure perspective. We had a lot of concerns from the U.S. consumer, saw things pulling back, that leisure had massively up, pulled ahead and had to normalize at lower levels, and we were seeing data that supported that. That's obviously what's played out over the past couple of years. Now we're getting to a point where we actually see things, maybe they're starting to turn around a little bit. And that's kind of interesting, right? Retail sales in October surprised to the upside on a month-over-month growth basis. The Visa spending index, this is actual spending from Visa and their credit cards. It's still in contraction territory. It's been there since March of 2022, below 100, but it's come off the bottom. The bottom for spending was actually in July, where we saw, and now we're looking at data that's, hey, we bounced off of that bottom, off of that trough, and we see numbers moving higher. The discretionary spending index has moved meaningfully higher, up 4% off of July's lows. So we started to see spending increase. Now, is that a dead cat bounce, or is that the start of a recovery trend? Well, we look at Deloitte data to help us understand that. And this is, instead of in-place data, it's forward-looking data, consumer spending intentions. And the solid line here is total spending. Now, total spending is still in contraction territory, but if you look, we've seen several quarters in a row of improvement, right? Or months in a row of improvement. Things are getting way better, bouncing off that trough, right? That May 2024 trough. 6 straight months of improvement. And each of the past 4 months are now materially above year-ago levels. And then the leisure travel spending index is meaningfully positive. It crossed the positive threshold in the middle of this year, and you've now seen 6 straight months of positive data points for forward-looking leisure spend. And we're seeing numbers that are reasonably strong. Past few quarters have been among the strongest that we've seen in a while. So this gives us a pretty encouraging sign that, hey, maybe people are looking to spend more going forward. And that bounce that we talked about from the Visa data, maybe it's not a dead cat bounce. It's the start of a trend. Now, we're not saying it turns, next week things are going to go gangbusters. Well, we're starting to see things start to shift for 2025, and it gives us a little bit of confidence. Then you layer in personal savings data. Now, for those of you that have not seen this webinar in the past, what I'll highlight about the personal savings data is real simple. The personal savings rate has a very negative relationship with how the how U.S. consumers spend. There's a negative 86% correlation between how much they save versus how much they spend on hotels and restaurants, right? They spend more, they save less, they save more, they spend less, right? Well, the forecast for spending, for savings, is actually expected to go down now over the next 3 quarters, meaning that we're going to start to see people maybe spending a little bit more than they had. The share of wallet is going to improve, and that's encouraging for hotels over the next few quarters, which will help 2025. After that, we do start to see things tick back up again, but it's a modest muted growth that doesn't generate a material headwind to leisure demand beyond that. Now, the untapped potential of the U.S. hotel industry is tied to foreign travel, right? If we focus on the bottom half of this chart, this is foreign inbound arrivals relative to 2019. What you see here is that foreign inbound volumes were down 16% from 2019 and 2023. This year, they're up 10% year over year, but still 9% below 2019 levels. Momentum has slowed pretty meaningfully this year, something that's a little concerning, but worth noting. Then when you look at international outbound travel, that's this top line here, right? That trend has generally been positive, and momentum, while it's not aggressive, it remains moving in an upward direction. When you look at that data, international outbound U.S. citizens traveling abroad, volumes were up 11% versus 2019 last year. They're up 9% year over year and tracking up 20% versus 2019 year to date. So this kind of points to the challenge that the industry continues to face, right? What gets this number to moderate and this number to accelerate, right? And the reality is, I'm not sure this number is going to moderate back down to 2019 levels. This may be a permanent shift to more travel abroad, given the affluency of the U.S. consumer and prioritization towards travel experiences. But this number should continue to move higher. And the biggest thing that's going to drive it to move higher and potentially drive this to stabilize a little bit or even retract a little bit is cost, right? Well, what changes cost? The value of the dollar. When the dollar is really expensive, U.S. destinations become very expensive for foreign inbound travelers, and international destinations become very affordable for U.S. travelers. The opposite is the case when the dollar is cheap, right? Well, this year, the expectation going into the year was the dollar was going to fall. We had seen the dollar rising for a couple of years. Fed was going to cut rates, and that typically translates into a declining U.S. dollar. Well, that started at the start of the year, but it quickly ended as the Fed rate cuts expectations, moderated, and other foreign banks started to cut rates as well, some of them in advance of the U.S., offsetting that impact. But the outlook right now is for the dollar to continue to fall. In fact, in 2025, the dollar is expected to decline 5%, and it will continue to decline into 2027. That should create a tailwind for foreign travelers to come to the U.S. and fewer U.S. travelers to travel abroad. I'm not saying it's going to be a huge tailwind, but it's an incremental positive, which will impact leisure travel. Now, who benefits the most? Well, not every market has a lot of exposure to foreign inbound arrivals. If you own or operate a hotel in Cincinnati, foreign travel probably isn't really driving your demand component. So don't get too excited. But if you're in Miami or New York or Honolulu, San Francisco, there's a lot more exposure, and that could point to upside. However, upside from recovery is based on how much your market has already recovered. So in markets like Dallas, DC, Atlanta, Houston, you've already seen foreign inbound arrivals back to pre-pandemic levels. We're not saying that these won't grow going forward. It's just not in the form of recovery. It's in the form of expansion. And there has to be a reason why it's going to expand meaningfully. Meanwhile, these markets down here still have a ton of recovery left back to 2019 levels. So we see a lot of upside from a lot of them as they gain momentum, especially Honolulu, Seattle, Los Angeles, et cetera, Orlando. And then before I jump on to the next slide, I'd be remiss, as we talk about the various different demand segments, if I didn't talk about kind of the 800-pound gorilla in the economy, which is the election and the upcoming new administration. So as we think about the election, I'm going to talk about two different things. Number one is what the implications of the general election were in 2024, thus, and what they might mean for 2025, just having an election. And then two is the implications of the new administration as it pertains to the hotel industry. So, first of all, election year impact, the general election, right? The reality is data unfolded in 2024 as we expected. If you look at the numbers today for 2024, like we expected, GDP growth decelerated from the prior year, business investment decelerated from the prior year, office and hotel demand growth decelerated, and RevPAR growth decelerated. This is exactly consistent with the trends that we've seen over the past 6 president general election years, consistent with our outlook, aligned with what we expected. Why does this happen? It happens because consumers and corporations alike pull back on their spending during the uncertainty of an election. So over the summer and into the fall, we saw a material pullback, and it showed up in 3Q hotel demand levels and operating results, and it showed up in some of the jobs numbers, and in some of these months as well in terms of hiring. The good news is the election's over, and we start to see basically some of that pent up demand for spending from corporations and consumers start to accelerate and improve. And we've already seen that post-election in the back half of the fourth quarter, and we'll likely see it in the first quarter and potentially into the second quarter. But it's not a permanent lift. It's just kind of a short-term bump tied to that pent-up demand. Now, as we go beyond kind of the impact from there being a general election and more focused on the impact of the new administration, I'm going to focus on the pros and the cons. And my apologies up front. There's a lot of text on these 2 slides, but I'm going to try to be brief and try to be clear about how we think this stuff impacts the hotel industry. Start with the pros. First thing, tax cuts. Tax cuts will be a positive when they materialize for the economy. That simple, right? Trump, at the end of the day, the reality is there is the expectation that the 2017 tax cuts will be extended and there will be new tax cuts implemented. However, the 2017 tax cuts don't expire until the end of 2025, and new tax cuts will require, and the extension of those tax cuts will require congressional approval. I'm not confident Congress is going to make this a high priority, given there is an urgency with the end of 2025 being the deadline. So this might be more of a 2026 story than a 2025 story from an economic growth perspective. Nonetheless, it will be a positive. Second, we're going to talk about government efficiency. Yes, President Trump has created the Department of Government Efficiency, or the DOGE, with the purpose of cutting a substantial amount of expense. The reality is the DOGE does not have authority to cut expenses. They can only make recommendations. Can Trump enact some of those recommendations through some of the things that he wants to do? Absolutely, he can. But a lot of recommendations that will require congressional support may be a little trickier. The reality is, do the Republicans have control of the House, the Senate, and the executive branch? Yes. Is there control, on shaky ground? Absolutely. Only a few seats in the House with a very bifurcated Republican Party, and only a few seats in the Senate. So it's positive, don't get me wrong, that things will get accomplished. But at the same time, how fast and how easy things get done remains to be seen. What we think is most likely to get done is a deregulation effort by President Trump through executive order, through appointments of federal, agencies. We could see a massive deregulation effect. That is encouraging, but deregulation doesn't translate into stymied economic growth overnight. That's likely, you're stimulating economic growth overnight. That's likely something that would be more of a 26, 27, 28 story than 2025 story. And then the energy markets. Is it true that the new administration is very pro-energy? It is true. They have made pledges to boost domestic oil and natural gas output, and they want to remove mandates on electric vehicle production. This all sounds really good to the oil industry, right? But don't go buying hotels in Midland, Texas, based on who's in the White House. What we learned over the past 3 or 4 presidential election terms or presidential terms is real simple. Obama and Biden were more conservative when it came and more cautious when it came to the energy markets than Trump, who was much more pro-energy. There was more oil output and natural gas output during Obama's 2 terms and Biden's 1 term than Trump's first term. Let me say it again. More domestic oil output, more domestic natural gas output during their terms than than Trump's. Why? Because who's in the White House doesn't necessarily dictate the economics of oil and natural gas production. There are many, many other components. Does the president make it easier? Absolutely. But the economics still have to play out. Cost of oil becomes a huge component. And believe it or not, OPEC has a much bigger say in what the value of oil is than the president of the United States. As a result, understanding those, understanding those drivers is a much bigger component here. So don't go jumping into energy markets just based on Trump alone. There are other factors that will play a role. Now let's move into some of the other factors that I would call cons, but they're more kind of nuances, especially the immigration policy. So let's talk about immigration policy. And this is kind of one of those things that we think that Trump has a relatively strong mandate to, make changes on. We expect a much more restrictive immigration policy that could also translate into mass deportations that's been discussed. I think the Republican Party feels like they have a lot of latitude here with the U.S. public, and that is likely to play out in the near term. That will have 2 consequences to the hotel industry. The first is from an operational perspective. If the economy at close to full employment, a reduction in the labor force of this type of unskilled labor, which hotels actually rely on quite a bit, will make it harder for hotels to find staff. That could drive wages up, could generate more overtime issues. Those types of issues are very, very real, which will likely impact margins. Not encouraging. Then there is the other side of it. The construction industry also relies on this labor pool. And they're also likely to see a shortage of available workers, which is likely to drive their labor costs up, which will drive construction costs up, and also extend development type timelines, which could be a positive in the sense that, okay, if construction costs go higher and development timelines are longer, that means we're going to see less supply growth. That's encouraging for hotel operating trends, right? RevPAR growth. Great. But then there's the other side of it. Well, that also pertains to renovations, right? And I don't know about you guys, but I've never seen a hotel underwritten or transacted that didn't include some type of CapEx plan. Well, now if your CapEx plan is going to increase by 15 or 20%, and the disruption is going to increase by 15 or 20% because it's going to take longer, that's going to lower the value that you're going to pay for the hotel. So that's the other thing. That's the other side of this that people have to pay attention to. It's operational and it's also value, which I think is very real. I'm not saying it all plays out, just things to be concerned about and be thinking about. Next, tariffs. Trump's proposed tariffs. I think there's been a lot of talk about this. The general consensus is that, yes, Trump is going to mandate tariffs. Through executive order, we're going to see massive tariffs he's talking about 10 to 20%, generally speaking, much higher on imports from China. Economists generally say that that's going to increase inflation by about 0.8% in 2025. That's not good for economic growth with inflation up. It may help ADR growth, but it's certainly not going to help demand growth. And it's also projected to be a drag on U.S. manufacturers. Doesn't help economic growth in 2025. Why are the tariffs? Why do we have tariffs? Because we have to offset the tax cuts. Why do we have to offset the tax cuts? Because of the fiscal deficit, right? And tariffs also have other components too. It's not just offsetting tax cuts. The reality is the U.S. federal government is in a fiscal position that's not ideal. Fiscal deficit is close to 6% of GDP. It's uncomfortably large. The economy is at full employment. The nation's debt to GDP ratio is just under 100%. which is up from 80% pre-pandemic. So we're adding more and more of that challenge. High deficit coupled with debt to GDP ratio that's way too high. It's expected to continue to increase. Proposed tariffs will limit the increases, but economists generally believe the tariffs will only offset about half of the impact from tax cuts going forward. So there's not this meaningful impact. Why does the fiscal deficit and the U.S. fiscal position matter to you as a hotelier? Great question. The answer is real simple. Rising deficits increase the fiscal risks of the country as a whole, right? As the country's government has a higher risk, the cost of borrowing from the country for the country's government goes up. So the U.S. Treasury yield, which is largely considered the risk-free rate, will increase in the yield it generates, right? Costs more to borrow money because you have your credit is lower quality, right? As such, even though we might see a declining Fed funds rate, as we expect over the next couple of years, and frankly, as we've seen over the last few months, the 10-year Treasury yield has actually increased, right? And the 10-year Treasury yield is usually considered that base rate, right? That base rate that investors are looking at, to understand what the return they're looking for in excess of that risk-free rate is. If the 10-year Treasury yield is that base rate, you're basically saying, hey, that base rate's going up. It increased 20 or 30 bips over the past few months following once it became clear that Trump was going to win because of these deficit concerns, and that's going to increase cost of borrowing and is going to increase cap rates. So all of these things come into play in terms of the hotel industry. So with that backdrop, I want to highlight a few things. Number one, when we look at 2025, and this is data from Moody's Analytics, the economists that we rely on, real GDP growth is expected to decelerate. Job growth is expected to decelerate. Average unemployment rate is expected to tick up. Corporate profits expected to turn negative. 10-year Treasury yield ticking up ever so slightly over the past couple of quarters, and then stabilizing around 4.2% in 2025. Those are some of the factors that drive corporate transient demand growth. They're not encouraging, right? Yes, we have office utilization expansion, which will help. But these are headwinds. Office utilization is a tailwind, and net we're looking at limited corporate transient demand growth. On the flip side, when we look at some of the factors that drive leisure, CPI growth is moderating, which is encouraging. Consumer confidence is actually getting better. We've got positive consumer confidence next year. And then we talked about the foreign exchange rate before. So we actually see tailwinds for leisure and headwinds for corporate from a macro perspective. Other assumptions that drive our forecast models. Fed's going to continue to cut rates by 25 basis points per quarter into 2026. Inflation moderating. The conflicts in the Ukraine and Middle East won't escalate, and then there's no near-term recession, but economic growth will be muted. Now let's move on to what all of this means to our lodging outlook. So start with our demand segments because it's the easiest way to think about things from everywhere we went. So if we start with corporate transient, which is a dark blue line, and this is kind of where it was in 2019, dropped off a cliff, has gradually been recovering. We think it kind of stabilizes where it is. We're not seeing a lot of growth. We're looking at it right around that 90% of 2019 levels, down 10% from pre-pandemic levels, stabilizing at those levels. We don't see meaningful growth in 2025. Group, the lighter blue, dropped. It's gradually been recovering. With continues to recover right through 2026. And group, we estimate to be a strong segment for 2025. And it will stabilize ultimately 10% above 2019 levels when you think about kind of where the new normals are. And then leisure, the gray, obviously spiked in 2021, then started to moderate. We think it stabilized in 2024, and we see ever so slight growth going forward, ultimately hovering around 15% above 2019 levels. So relative to 2019, leisure is the clear winner, followed by group, and corporate transient is the clear loser. In 2025, relative to 2024, group is the winner. We see group having the strongest growth. Leisure, we think, will be slightly positive, which is a big improvement from the material negativity we've seen over the past couple of years, while corporate transient will be flattish, which is I would call it negative relative to where we were the past couple of years. Moving beyond demand, we look at supply. Here's the reality of supply. Supply growth is incredibly muted. We don't see a lot of risk to supply growth nationally. There are pockets where supply is a concern. We'll talk about one in a little bit. but at the end of the day, supply growth is forecast to only be 0.9% next year. In 2025, this is about half of the long-term average of the U.S. industry. Forecast over the next 5 years is just 0.8% CAGR. Really, really muted supply growth. This is encouraging for the industry. And given where construction costs are likely to go over the next couple of years, these numbers may even prove high. But supply to us is not a big risk. Our RevPAR model, I'm not going to spend a lot of time on this, but the dark blue line is the actuals as reported by STR or CoStar on a seasonally adjusted basis. Light blue line is the model that we've built to forecast that data, forecast that RevPAR. We forecasted that RevPAR historically, leveraging the actual results from these metrics. We did not forecast a pandemic or the Great Financial Crisis, but layering in what the actual results were for those facts during those periods, we've been able to build a model that incorporates the impact from the falling GDP growth and corporate profits and rising unemployment and what that had. And then based on the forecast from Moody's Analytics for those metrics, you can see where our RevPAR growth forecast is. For those of you that don't remember your stats class from college, 98.7% R squared basically means that this model has historically forecasted 98.7% of all the variance of RevPAR growth. Same thing for ADR here, dark blue actuals, light blue our model, R squared 98.9%, drivers right over here. You put all that together, you get our actual forecast along with everybody else's forecast we've got on this slide. I'm going to focus on 2025 here. Our forecast for 2025 is flat occupancy, ADR up 2.7%, driving RevPAR to be up 2.7%. Couple things I'll highlight. Our ADR and RevPAR growth forecasts are the highest among all the major forecasters for the hotel industry. Our occupancy, however, is tied for the lowest with HBS. We are the most conservative for occupancy, but we are more aggressive in terms of ADR. Interestingly, when you look at the actual forecast for 2025, STR in November released their forecast of 1.8% RevPAR growth. When we pulled CoStar's data a few days ago, it actually said 2.6. I don't know why there is that big variance there. My guess is that is because maybe CoStar's model got updated with some new data that wasn't incorporated in the STR data. Hard to say, don't really know the details. Net, that's something to ask your CoStar rep or your STR contacts if you're curious about it. But regardless, we're pretty optimistic for 2025. 2026, we're a little bit more cautious than the other guys. When we go back to 2024, as you can expect, we should all be right around the same place. We've got 10, 11 months of actual data by now. And we all are around the same place of around 1.4%, with the exception of CBRE, which has RevPAR growth of 0.5% for 2024. I do not know why CBRE's forecast is as low as it is for 2024. I can only speculate that it's because CBRE is forecasting different data. CBRE is forecasting RevPAR off of Calibri data rather than STR or CoStar data. And as a result, maybe their forecast of 0.5% is spot on for Calibri data, but the Calibri data is much, much lower than the STR data. Again, the data sets are not the same. We are strong believers in the STR CoStar data, which is why we use that. Moving from the annual forecast to a quarterly forecast, I'm going to focus on the quarterly for 2025 here. When we look at 1Q 2025, you've got tailwinds in 1Q, where we're going to see really strong growth tied to the Easter calendar shift back in March, as well as some of those tailwinds from the general election, which we see unfolding in the first quarter. In 2Q, you've got more headwinds tied to the Easter calendar shift, as well as the solar eclipse from 2Q 2024. But you get some of those general election pent-up demand dynamics as well unfolding in 2Q. And then in the third quarter, by now, we start to see the impact of our leisure story start to play out, and we see some strong growth. And then the fourth quarter, we have really difficult comps. Those comps are largely tied to hurricane displacement across the Southeast in the fourth quarter that have driven RevPAR higher this quarter. Like we're forecasting around 2% growth this quarter. So that gives you our quarterly outlook for 2025. Again, occupancy flat, ADR up 2.7%. As we move to the price classes, when we think about 2025, at the end of the day, we continue to like the high end more than the low end of the different price classes. But I will say that if you look at kind of the changes, mid-scale and economy were meaningfully negative in 2024. They're going to be positive in 2024. So they're seeing improvement It's just their growth isn't as strong as what we're seeing at the high end. And then relative to 2019, RevPAR growth is clearly strongest and has been strongest coming out of the pandemic at the high end in the luxury segment, and the weakest in economy, followed by mid-scale. While the other segments are all pretty close to one another, we're expecting upper upscale, and upper mid-scale to all be 15, 16% above 2019 levels in 2025. Now, why should you trust our forecasts over all those other guys that I just showed you? Well, I think it's real simple. In our view, I think when you can get into a lot more detail on this, if people are ever interested, feel free to reach out. But short answer is we believe better data in equals better data out. We believe we use the best data providers to build out our models and our forecasting. And two of the things that stand out to us versus everybody else, number one is we're the only forecaster that uses Moody's Analytics in our economic forecasting. The other guys use some of the other forecasters. We think that's a differentiating point. We believe Moody's is the best in that world. Number two is we're the only forecaster that uses convention pacing data, that gets the data from the local CVBs or the DMOs, the convention centers, and builds that into our forecasts. The other guys don't. I can't imagine forecasting for a lot of markets without that data, but people do it. And then so that's why. Now, what are the results? Well, let's take a look at 2024. So if you look at our forecast at the start of this year versus actual results, we were all high. We all had expectations that RevPAR growth was going to be better than it has played out. There's no doubt about it. We were more conservative than everybody else. In fact, we were the only one that was forecasting negative occupancy growth. And yes, occupancy has been negative. We actually were a little light on occupancy, right? We were 0.3% off, right? Forecast, ADR, we were all hovering around that 1% ADR growth for this year, but net, we missed RevPAR growth by 1.1%. Everybody else was 1.5% or up to 2.7% above actual results for 2024. If you think 2024 is a unique story for LARC, you'd be mistaken. We were more accurate than the other guys in 2021, more accurate than the other guys in 2022. And in 2023, we actually give credit to PwC being the most accurate. They were the only forecaster within 1% of occupancy, ADR, and RevPAR. Only us and PwC were within 2% of occupancy, ADR, and RevPAR in 2023. So 3 of the past 4 years, we've been the most accurate. In the 4th year, we were the second most accurate. And it's not just at a national level, it's also at a market level. This is a look at our 62 markets. Dark blue is how much we missed the RevPAR forecast by for 2024 estimate now, obviously, versus where the other guys are, the leading provider. We're more accurate in 70% of our markets. On average, more accurate by over 100 basis points. We got 1.4% RevPAR growth this year, and we're more accurate by almost that amount across all our markets. That's a big spread. That's almost 100%, right? And then here's another one that's kind of interesting. The other guys missed RevPAR growth by 5%, by at least 5% more than us in 13% of our markets. That's a huge miss. We didn't have those big misses with the exception of 2 big markets, Maui and Sedona. Maui wildfire impact was really hard to forecast. Sedona, the market definition was changed by CoStar, and that had a meaningful shift in the actual forecast. So it's not really apples to apples comparison. But outside of those 2, we were pretty close in most of our markets. We feel really good about this. The other guys are much, much farther off. And if you think this is unique to 2024, you'd be mistaken. Our RevPAR forecasts were, again, more accurate in 2022 across 70% of our markets, and more accurate in 2023 across 70% of our markets. Consistency of being more accurate than the other guys. Now let's talk about beyond the top line. Now that you know you should trust our top line forecast, talk about our bottom line forecast, right? So I'd be remiss if we didn't spend a little bit of time talking about labor costs. Labor expenses are driving pretty meaningfully. And a lot of it is tied to collective bargaining agreements. And we spend a little bit of time on this. We go through this really fast. I did this last quarter, so I don't want to spend a ton of time on it. But at the end of the day, from an owner's perspective, owners don't want to spend more money. Owners and operators don't want to spend more money on wages and across most union markets, because union markets have generally underperformed coming out of the pandemic, right? Growth from 2019 to 2023, union hotel markets have seen EBITDA grow 20% less than the U.S. average. And margins are still down over 250 bips from where they were pre-pandemic levels. So how do they want to spend more money? But then there's the union and the labor component of things, which says, hey, we used to see wage growth in excess of the national average. We're in more expensive cities. We see more, higher wage growth, an average, 1.7% more per year than the national average or from 2009 to 2019. Well, 2019 to 2023, we didn't see that. It was the opposite. Massive, massive disappointment here in terms of, wage growth really underperformed the national average. And as that continues to, and that's the headline, right? Labor feels like they're owed catch up. And owners and operators are saying, hey, we don't have anything spare to give. And that's translating into contentious negotiations, which has led to all these strikes. In LA, an agreement was reached earlier this year, which increased wages by about 40 to 50% over the next 4.5 years. You know, just to give you guys an idea, we see just adjusting 2023 labor costs to where the U.S. averages were in 2023, growth from 2019, you'd be looking at a reduction of 14% hotel EBITDA and margins down 320 bips in 2023. So massive, massive impact, major headwinds as this plays out. We don't think this reset occurs overnight across all these markets. It's going to be gradual, like we saw in LA, but there's a big headwind coming from a wage growth perspective across all those urban markets that have a lot of union exposure. And if you think that headwind is just tied to the union hotels, you'd be mistaken. Why? Yes, the negotiations are with union hotels and the unions themselves. But the reality is the biggest challenge with union hotels is not the wages, it's the work rules and the work restrictions, right? Well, that means that non-union hotels are willing to pay more to keep the unions out of their hotels to avoid those work rules and work restrictions. So if the union is paying X, the non-union hotel will pay Y. What happens when the union now pays Z? What do you think the non-union hotel is going to do? There you got it. So this is going to impact the broader market, not just the union hotels. Overall, our expense growth outlook points to an acceleration in expense growth, despite the fact that we have no occupancy growth in 2025. Wages will increase 3.2% CAGR through 2028. Property taxes about 4.8% CAGR. And then you get our overall expense growth forecast here. That drives our EBITDA growth, which is negative this year, slightly positive over the next couple of years. We see some growth in 27 and 28 as well. From EBITDA, we build out our cap rate forecast based on the outlooks, primarily based on BAA bond yields and bond yield spreads. We're seeing cap rates rising over the next few years, not falling, despite the fact that the Fed fund rate is declining, because these things are moving higher, risk premiums going up. Our model has a 98.5% R squared, and you put it all together and you get our overall forecast for 2025 and beyond. And here's what you see. Basically, if we focus on 2025, supply and demand will largely offset one another. ADR is going to drive RevPAR growth of about 2.7%. We're going to see modest EBITDA growth with margin contraction in 2025. Values will tick up as we see positive cash flow growth, right? Despite the fact that cap rates are expanding, 10, 20 bips or so. Longer term, we see very muted occupancy growth. ADR growth will be slower than it is in 2025. Hotel EBITDA growth will also be positive but muted. Margins will contract. Values will increase 2% a year over a 5-year period. How has our forecast changed for 2025 versus last quarter? Not much, right? RevPAR is about the same, 2.7 versus 2.5. Hotel EBITDA about the same, a tenth of a point different, and hotel value is about the same, right around 2.5% growth in 2025. Now, one thing that I'd be remiss if I didn't talk about is kind of the cyclical dynamic of hotel value recovery. This cycle, values fell precipitously in 1 year and bounced back really quickly, and then they've been on a slower growth trajectory, and we expect that to continue. Last cycle, we saw values fall just as far, but it took 2 years, and the recovery was a little bit slower, but momentum was stronger by the time we got to this point, and they saw growth in the latter years of the cycle. What's different? Why are we not seeing this type of momentum, and we're forecasting this type of momentum? It's very simple. This is that base rate component. Interest rates were much, much lower. 10-year Treasury yields had a 2 handle on them versus a 4 handle today. That has a big impact on cost of capital and the returns required. And that's going to keep values in check. Now let's move on to markets. I'm going to be relatively quick as I go through this. We look at these, so these are the 62 markets we issue quarterly forecasts for. If you're interested in learning more about our forecast reports, they're unlike anything you've ever seen. If you haven't seen them yet, I encourage you to reach out. We're happy to connect with you on it. Historically, nationally, GDP and RevPAR growth have a very, very strong relationship. You can see it over time as well as since the pandemic. We've seen really, really strong relationship, right? However, at the market level, that relationship totally breaks down. The correlation is about half of what it was, and the R squared less than 20%. And then since 2019, non-existent at all. So focusing on factors like GMP growth at the market level will often leave you in a situation where you have not fully understood the market and you get yourself into trouble. We do not recommend that. When we look at our 2024 outlook for RevPAR growth, here's where you can see bottom line here is the top performers are those that experience strongest growth in outsized exposure to Asian international demand, corporate transient demand, and/or have strong convention capacities. Houston obviously benefiting from the displacement demand tied to Hurricane Beryl. Weakest growth is markets predominantly tied to domestic leisure demand and soft group booking paces. Maui negatively impacted by the wildfires. As we look to 2025, here's our forecast for 2025. Strongest growth, again, Asian international demand, improving domestic leisure now, and/or have strong convention paces. Maui has really soft comps tied to those wildfires that we just talked about before. The weakest markets are those that predominantly cater to corporate transient demand, have limited international exposure, and have soft group booking paces. Kauai faces headwinds tied to the benefit they got from the Maui wildfires. Houston, the impact from Hurricane Beryl with all the displacement demand also weighs on that. Indianapolis had a lot of kind of what we call one-time special events in 2025 and 2024, whether you're talking about Taylor Swift concerts or U.S. Olympic trials, you name it. We think that creates some headwinds for Indy in 2025. And then when we look at the 5-year RevPAR forecast, top performers are those that either have soft comparisons from 2023 being the baseline year here, strong markets going through major shifts, bringing added demand, Las Vegas, sports tourism, Palm Beach, Wall Street South, Raleigh, tech expansion, other markets with outsized leisure exposure and strong economic trends like Sedona, strong international demand, group bookings. Those are the markets we really like over the long term from a RevPAR growth perspective. Bottom performers tend to lack material international demand, have sluggish economic growth, soft convention calendars, or tough comps, which certainly plays out for some of those. And as we look beyond RevPAR and we focus on value, our favorite markets, top 5, I don't think has changed over the past quarter. Maybe the position of where they are has shifted a little bit. We love Puerto Rico. We think that's a market that is going to continue to see a lot of growth, a lot of opportunity. It's going to be transformed by a new energy grid that's going to infuse a tremendous amount of commercial activity into that market and investment into that market, which is going to spur corporate transient demand growth, help drive leisure demand growth. Great airlift to Puerto Rico. We think those are really, really strong dynamics. Vegas, I just talked about kind of the sports tourism. There's also really strong economic growth and a growing corporate segment. New Orleans, great convention calendar, improving domestic leisure demand, all good for New Orleans. Bottom, soft convention calendar in Austin, where the convention center is closing in March. Difficult comps in Boston, St. Louis, and San Diego. And then elevated expense growth, Boston, San Diego, and Chicago, limit our outlook for values in those markets. And then real quickly, I'm just going to jump into one market in particular, and it's Atlanta. Atlanta is a market that a lot of people ask us about because Atlanta screens really, really well. If you look at the macro factors, economic growth is better than the national average. In fact, all the factors that drive corporate demand generally look pretty good. Office employment stronger than the national average. Information technology, economic output, financial services, professional services is pretty close. These all look really good. In fact, economic growth ranks 24th of our 62 markets. So this is really good. Now, yes, retail is a little soft and that will weigh on the market to an extent, but it's not bad. It's nothing to be discouraged about. So the economic growth looks good. So invest in Atlanta, right? Well, you can't just focus on the economic growth. we've got a really soft convention calendar the next couple of years. 2025, convention booking pace is down 25% year over year. 2026 down another 6%. And then there's also been some supply. The Signia by Hilton opened in January 2024, a new convention center hotel with the idea of boosting convention demand to the market, having another convention center property. That has not materialized, right? And maybe it does by 2027, 2028 when we've got some stronger pacing, but it's still early days for those for those years. So we'll see how they ultimately play out. But convention calendar looks pretty soft over the next couple of years. Then you look at supply. Now, on the surface, supply looks pretty fine, right? The market has inventory under construction of just 2.1% of total inventory. Planning's a little higher, but that's just planning. Who knows what will materialize? Supply growth in 2025 across the market is going to be muted. It's only 1.0% in 25. It's going to grow at a 1.2% CAGR through 2028. That's kind of middling for all 62 markets that we track, ranking 29. Fine, right? Supply is not an issue. Not so fast. So if you look at the CBD specifically, number one is you saw 7% supply growth in 2024. We talked about the Signia earlier. Two is you have another 4.6% of inventory under construction, nearly 1,000 rooms, two hotels scheduled to open at Centennial Yards in 2025 and 2026. Another hotel schedule was just filed for at Centennial Yards, another 127 rooms. Here's the reality about Centennial Yards. Centennial Yards, for those of you that don't know it, is a massive mixed-use development in downtown Atlanta next to the Georgia World Congress Center. When it was initially conceived, it was expected to have millions of square feet of office space. All of the office space has since been scrapped, and they're now just building residential and hotels. There is talk that there could be a total of 3,000 hotel rooms being added in Centennial Yards alone. That's 15% of the submarket's hotel inventory, right? This is adjacent to the convention center and right downtown. We think it's going to have a huge impact on the CBD, which will obviously drive impact on performance across the broader market, where you just don't have the compression. It limits pricing power across the market. Is it going to have a huge impact on the Alpharetta submarket? Probably not. But overall, for the broader Atlanta market, it is. And then when you look at where RevPAR, our forecast model for RevPAR, you do have some nice things. World Cup semifinals in 26, Super Bowl in 2028. That's what you see these kind of little bumps are here because they get built into our forecast models. Our model has a 99.4% R squared, as you see there, the drivers of the model. And then where is RevPAR growth going to be strongest, in downtown Atlanta, if you will? You see it right here. The macro fact, these are the developments that are unique that we think could add some demand and could be interesting, especially the $1.5 billion new hospital expansion right there. But bottom line, this data all comes from our LARC GIS application, which is super cool. If you haven't seen it, reach out. We can shoot you over a demo. You can actually select a hotel or a development site and draw an area around it and pull the RevPAR growth forecast for that area. It's pretty amazing. This is just a 5-year heat map that you see here. And then when you think about our overall forecast accuracy for Atlanta, let's take a look at 2024. Today, we estimate that Atlanta is going to come in about negative 1.9% RevPAR growth in 2024. Our forecast as of this time last year for 2024, negative 1.7. We were pretty good, really close, right? 20 bips off, feel pretty good about that. The other guys, positive 5.4. Not only did they miss terribly, they missed in the very wrong direction. How can, if you care about market forecasts to help you with building your budgets, pricing your inventory, leveraging, for underwriting multi-million-dollar investments, how can you rely on anybody else? Obviously, I'm preaching my book here, but it just seems obvious to us. And then for 2025, we're a little bit more conservative than the other guys. We actually see things getting a little bit better as leisure improves across the market, but overall, we're relatively cautious. And for those of you that don't know, we issue 3, core service offerings, quarterly market intelligence reports. If you haven't seen one, reach out. We'll send you a sample. They're amazing. We do a lot of commissioned work, consulting work, totally customized, always what the client's looking for. And then I mentioned our LARC GIS application. It's really amazing. You can download what we call a location intelligence report for any hotel or development site in the country. Amazing data in there. I strongly recommend you check it out if you have not already. And with that, I am going to turn it over to Katie for some Q&A. Sorry we went 5 minutes over there, but thought some of those things were really important to highlight. Katie, how are we looking?
Sounds good. We have a few questions here. I will share that we will send the PowerPoint over email, and the recording of the presentation can be found on our website. So I will skip any questions regarding that. But when you show growth numbers for ADR and RevPAR, are you adjusting for inflation? If not,
No,
why not?
no,
To me,
no.
it feels, oh,
Okay,
sorry.
keep
To
going,
me,
keep going.
it feels disingenuous to say RevPAR is up X% when it's still below inflation, meaning it might as well be negative rather than positive. What do you think about showing inflation in your reports? Thanks.
So great question. We always talk about inflation because it's a factor, but at the end of the day, is your salary adjusted for inflation? Do you adjust how much money you make when you think about what your income is based on, well, inflationary growth? Probably not, right? You know, Hotels operate with multiple expenses and multiple revenue streams, right? And you don't necessarily adjust them all for inflation. If you're adjusting revenue for inflation, shouldn't you be adjusting expenses for inflation too? And overall NOI. And at the end of the day, when you deposit a check in the bank, are you adjusting that for inflation too, or are things being done on a nominal basis? Don't get me wrong. I think understanding the real value is important, but at the end of the day, um, you know, there are, nominal metrics are what go to the bank, and that's why we focus on that.
I see you're doing many year-over-year measures, but a few comparisons to 2019. Do you think it's still relevant to compare our current data versus 2019, or do we have enough reliable data in 2023-24 to begin moving away from comparing to pre-COVID?
Yeah, I think for the most part, it's less about 2019 and more about what the year-over-year growth is, and that's where we encourage our clients to focus on. That being said, when you're looking at long-term trends, it can be helpful to point out how things have strategically shifted since then, because we have seen some strategic or secular shifts coming out of the pandemic that are worth addressing. And that's when we talk about things relative to 2019. That's a lot of what we're trying to focus on is this structural shift that came out of the pandemic as opposed to recovery, if you will.
Where is the negative 5% in the US dollar 2025 forecast coming from?
Moody's Analytics, they're the economist we rely on for forecasting.
Do you know what the supply CAGR was prior to COVID? Let's say 2016 to 2019, just a data point to bounce your current supply CAGR numbers.
Sure. We look at data from 2000 to 2019 was about 1.8% supply growth on a compound annual growth rate basis.
Do you think there is more opportunity or risk in your overall US RevPAR growth projections?
That's a great question. I mean, look, we're obviously more bullish than the other guys. So in that regard, you would point to more risk than opportunity. But I think we're feeling pretty good about what's going to surprise on the leisure front in 2024. And our numbers incorporate a much more modest corporate recovery. Then I think there's potential there that surprises better than we're currently building out. We don't really know whether corporate profits are ultimately going to be negative, and if they end up being better than expected, and the stock market continues its kind of historic run, that could fuel corporate transient to surprise to the upside. So I think how I feel it being the highest of everybody is probably that there's more risk, but if I think about it analytically, I think there's probably more upside.
Can you provide me with San Francisco's market report?
Well, we're happy to sell it to you. Feel free to reach out to us, and we'll try to coordinate with you.
Actual supply consistently comes in lower than the LARC forecast. For example, 3Q22 forecast for 2023 was 1.6, which actually ended up as 0.3. 3Q23 forecast for 24 was 1.6. Year to date through October, US supply is up 0.5. Does LARC not account for supply removal, or is there some other reason for the consistent gaps?
Yeah, I think that's a great question. And I think historically, we had not tried to account for permanent closures that had not been announced. That is something that we have changed, and we now take that into our forecasting. But it was very hard to incorporate permanent closures when we don't know what hotels are going to close. We've taken kind of a broad swipe at it today, but yes, you are spot on that in 2022 and 2023, our supply growth numbers ended up being way higher than where things ultimately netted out because of permanent closures that materialized that we did not expect. Keep in mind, I don't think anybody expected the 25,000 rooms in New York and the several thousand rooms across Chicago and Boston that were taken out of inventory for um, migrant housing. That certainly has played a role into some of those numbers.
What is driving DC's 5-year strong RevPAR CAGR?
I think I don't know that, when you think about the forward 5 years, I think that part of it is that 2023 baseline that's low. You've got foreign inbound arrivals. You've got the inauguration, which also will be 28, 29. You'll see some of the benefits from that, which will play a role there to an extent. But you also have DC is a tale of a lot of different markets. And I think we're seeing a lot of corporate growth and really a lot of strength in the Virginia suburbs. Downtown faces challenges tied to the federal government. But ultimately, we're seeing stronger leisure demand to DC that is driving a lot of the demand across that market. And we think that will continue. And you layer in a really strong convention calendar from the Walter Reed Washington Convention Center, and it's just a recipe for solid performance.
Any thoughts on Airbnb leakage and which markets are most impacted?
Mm. So we track exposure from short-term rentals across all of our markets. Be surprised, for the most part, short-term rentals, aside from a handful of markets, generally have less than 5% impact on the hotel industry. And the regulatory environment has a big impact on how that changes from year to year. We actually track all the regulations and how that's changing and publish that in our market intelligence reports. So I'd encourage you, if there's something that you're particularly looking at, reach out to us and we can let you know what's available for purchase.
What are the effects of STRs on lodging outlook?
I think that's pretty similar to what I
Mhm.
just referenced. We think that it's marginal. Our general view on short-term rentals is that on the margin, it has an impact. But if you look at, what we call hotel comparable rentals, studio or one-bedroom whole unit rentals, they're a small component of the overall accommodation sector for the nation and most markets we cover. I think for the U.S. it was 4.7% of overall revenue. So it's a small component. It's not huge. We don't think the guy sharing a couch or a spare bedroom or the 5-bedroom house rental is comparable to hotels. You're not making the choice of a hotel or that, generally speaking. So we don't see a ton of risk from them. That being said, it is continuing to grow. And that growth is really being fueled by inventory and supply more than ADR or occupancy. So it's all about supply. And as regulations curtail that supply growth is meaningfully slowed, revenue growth has meaningfully slowed over time, and exposure has slowed. But generally speaking, we think that it has an impact on compression nights when you can see that inventory is expanding, tracked, where we see less pricing power during some of those major compression periods.
Does LARC provide any analysis or forecast where extended stay demand outlook is broken out of the larger market data?
It's something we've done for clients in the past, but it's not something that is off the shelf readily available.
Orlando as a market, do you think there is risk to the tailwinds, park opening, convention pace, international recovery?
No, we feel really good about those three things, right? Epic Universe is opening. The convention calendar is phenomenal. We think that it's going to drive more foreign inbound arrivals to that market.
And that was the last question.
Great. Well, thank you all for taking the time to join our webinar. If you have questions, want to circle up after, feel free to reach out. Email information at LARC Analytics is here, or ryan.melliker@larkanalytics.com. And like I said, we'll shoot out the slide deck as well as the link to the recording will be on our website later today. Thank you all very much and have a wonderful day.